So there seems to be a little bit of a split. There's a few, couple of dissenters on the board who are much more worried than you seem to be about inflation threat, possibility of stoking inflation that can't be easily unwound. How likely is it that the FOMC might go the way you're suggesting and provide more accommodation?
You know, that's it's a committee. I think we've all served on committees, so you bring forward your views, try to be as articulate as you can be to persuade your colleagues of your point of view, and I work to do that all the time. And at the same time, I'm learning from what other people are saying, and you know, if I'm certainly open to evidence and new ways of thinking about things, and if people bring forward evidence and thinking that I find persuasive, I'm certainly open to incorporating that into my view and policy. So you know, beyond that, I don't think I have much to say to answer that question.
Do you see any credible evidence that the concerns that they have are justified?
Well, you know, I talked today about adopting more accommodative policy stance, and I talked today about how I thought that policy stance would influence the inflation outlook. I think if you go backward the last 15 years, the inflation outlook hasn't risen above 2.25%, even as unemployment fell below 5%. I think there's been a movement in the FOMC's evaluation of that long-run unemployment rate consistent with 2% inflation. If you go over the last 5 years, that's gone up a little bit. But I feel very comfortable with the idea that inflation would remain below the 2.5% level, that the outlook would remain below the 2.5% level, even if we had an unemployment threshold of 5.5%. But what if I'm wrong? You know, I guess, you know, that's a question we certainly ask. And what if I'm wrong? The answer is that if the inflation outlook were to rise above 2.5%, we meet 8 times a year. We can react very rapidly to that such an outlook, and the way we would operate in that situation is by reducing accommodation. We can raise interest rates, raise interest rate on reserves. There's a number of different actions we can take at that stage. So I think we have a lot of power to. I don't see it as much of a risk, but if the risk were to manifest itself, we have a lot of ways to respond that would keep us in the business of promoting price stability as mandated by Congress.
I'm Jim Hamrick from the Business Journal. Do you think that a looser fiscal policy from Congress would be more accommodative to the economy? And what would that look like? You know,
I would say that certainly the path of fiscal policy influences my outlook for the economy. You know, if you look at my outlook today, it's not that different from what it was in January, but sort of the sources have changed. I think the private sector looks stronger than it did in January to me. I think, you know, improvement in the labor market has been stronger than I would have anticipated on the private sector side. You know, on the public sector side, I think that fiscal policy is going to be tighter in 2013 than I would have anticipated in the beginning of the year, and that has downward pressures on both prices and employment. Yeah.
You refer to this as continuing to be a moderate recovery, but I mean, I guess in a more positive spin, would you also call it a self-sustaining recovery at this point? Are we pretty solidly, you know, out of real peril?
You know, I think that there's uncertainties about any outlook, but if you were to ask me about the chances of I'm not quite sure what you're asking me. The chances about the growth path would be lower than what I forecast is about half. If it's higher, it's another half. So it's if you're asking for a probability of a very low outcome, say below 0 over an extended period for growth, so what we might think of as a recession, I think of that has been very unlikely.
I guess one way I'm trying to think about it is like there have been all these threats like fiscal cliff talks and the sequestration, and it doesn't seem like those have actually resulted in major shocks to the economy, which would maybe suggest that there is this inherent strength in the economy.
Well, I have been pleasantly surprised, I think, by the strength of the private sector over the last few months. You know, we don't want to get too carried away with that in the sense that we've seen something like this before in the early part of 2010, the early part of 2011. So we want to be careful with drawing too much of a conclusion from a few months of data. With that said, you know, I think it's definitely a positive that the economy has been as strong as it has in response to the kinds of shocks you've described. You know, you have to be careful drawing too much of a conclusion about any information, but certainly I don't think monetary policy has been helpful in that. I think the stance that we took in September, which was to be more open about what we're trying to achieve through policy, more open about the fact that we stand ready to be accommodative over an extended period of time, even as the economy recovers, I think was very helpful. But again, we're looking at a few months of data. You don't want to draw too much by way of conclusion from that. Yeah.
You obviously talked about the uncertainties you have to bake into your forecast. How do you go about baking the best uncertainty of them all, which is what Europe does next?
Well, so Europe affects the U.S. economy, I think, in a couple of different ways. One is the growth of demand from Europe for U.S. products, and that, you know, that's Europe is struggling right now. So that kind of source of demand is remaining low, and it's going to remain low, I think, over the next year or so. From the U.S. perspective, fortunately, that's a limited drag on our growth. Our trade with Europe is relatively small relative to the economy as a whole. What we worry about more is financial market kinds of spillovers, so that the kind of contagion effects that you get uncertainties manifesting themselves in European financial markets and spilling over into American financial markets. So I'll say a couple of things about that. I think the stress tests, the net results that the Fed announced a couple of weeks ago on the stress test for large financial institutions in the United States, you know, I think I should provide a lot of comfort to Americans about the ability of our financial institutions to be resilient in the face of very extreme kinds of shocks. And so that's one positive source of information. And so I think that it's a sign of the kind of rebuilding that's gone on in the financial sector to be more resilient against extreme shocks. And so I'm less worried about that eventuality than I was 2 years ago, say. I think just a lot of good work has gone on to both within the banks and then on the part of regulators to help the financial sector be more resilient against that kind of outcome.
It sounds like you're a little more optimistic than you were a couple months ago. So can you take us to the pace of purchases and going through the year into next year? How that's changing on the better data that you just cited?
Actually, I think, without meaning to gainsay you, I think my outlook is almost identical to what I had 2 months ago. So I might be feeling more upbeat though, so that's good. I got a nicer tie on. No, but more seriously, to get to your question, you know, I think this is one of the reasons I would say that I've leaned more on providing extra accommodation through forward guidance about the Fed funds rate is the clarity associated with it, and it's been challenging for the committee to provide that same degree of clarity about asset purchases. And I think that you listen to the dialogue from different people have different views about that, and have not been able to come together as a committee and articulate a clear conditionality surrounding the path of asset purchases. I think that makes it a weaker tool. You know, I think the fact that we're able as a committee to provide the degree of clarity we are about the Fed funds rate, I think makes that the stronger tool relative to purchases right now in terms of providing the extra accommodation that I've suggested that we need. Yeah.
So in translation then, when do you stop then? When do you start pulling back on accommodation?
That's going to be a committee decision. It's the, you know, I'll say a couple of things about that. I mean, I think that there's, 0, 1, there's 85 billion to 0, there's range in there. So there's a way to respond to the inflow of economic information without stopping Conversely, just to be clear, if the information flow was worse than you expected, there's numbers above 85 billion as well. So you want to be clear about that. But I'm not going to give you an answer to that question, and the reason I'm not going to give you an answer to that question is because I really want the committee to come together behind an answer to that question. And I think that's what's helpful. For me to give you the answer right now is not helpful. For the committee to come together behind an answer is helpful. And that's what I'm hoping we're going to be able to do over the next few meetings.
Your cohort in Atlanta is specifically encouraging a pullback in the mortgage-backed securities purchases. Do you have thoughts specifically on?
He's a very articulate man. He can express himself more clearly on his behalf than
if you have any particular thought, in terms of where the housing stands.
No, I think I presented my outlook for the economy. I don't see that outlook as consistent with the need to reduce accommodation. Inflation is running below target. Unemployment is running above what we view as being consistent with max employment. It seems a time for more accommodation is required, and I've suggested how we might proceed to do that.
Any feeling on timing for tapering asset purchases, or granted, you want more accommodation now, or communication about that, or the mix that should change?
I feel like the questions are all coming around at the same point. No, I'll come back to I think what's been challenging with, so in September, I was asked about this, and I was happy with what we did in September in terms of both the program we announced, and also I think we offered, I think, more helpful language about the path of Fed funds rate in September. Then in December, we took a significant step forward, providing more precise quantitative guidance about the Fed funds rate. We didn't do that with asset purchases. And that's what I see is the big hole right now in our communication. And it's not helped by my standing up here and giving my particular views about tapering or stopping and all that stuff. Would be helpful is for the committee to come together and provide more specifics, quantitative specifics about what does this term substantial improvement in the labor market outlook mean. I think that's what would be helpful. It would provide, just as we did the thresholds, the goals that we've been describing in terms of monetary policies, helpful in terms of accommodation being provided by the Fed funds rate, would be similarly helpful in terms of thresholds.
May I just follow that point? Does that mean that the summary of economic projections should be changed to?
No, I was asked. No, not to take you through the history of what I've been asked. I'm thinking more that the statement itself, just like our FOMC statement, provides guidance about how long we're going to keep the Fed funds rate extraordinarily low. We say we're going to keep it extraordinarily low until the unemployment rate falls below 6.5%. We're vague about asset purchases. We say we're going to continue asset purchases until we have a substantial improvement in the labor market outlook. As soon as that was announced, there were questions from the media and others, quite naturally, about what does that mean? We should be able to provide more guidance about what that means, specific quantitative guidance of the kind that we did on the Fed funds rate. That's what I have in mind. No, I do not have in mind adding more charts to the summary of economic projections.
I'm sorry, you said specific quantitative guidance?
Yes.
But much, similar to what we provided for the Fed funds rate. So there, for the Fed funds rate, we provided a very clear definition of what we meant by the kind of improvement we would need to see in the labor market before we would consider raising rates. We translated that into a 6.5% unemployment rate. It would be very useful to be able to provide the same kind of specificity about what we're doing in asset purchases. Is that making sense?
I have a question about housing. As prices are starting to tick up, there's some concern that investors who have really been propping up housing by buying a lot of these distressed properties, that they're going to maybe leave the market, and then we're going to see weakening in the housing market, so that its recovery is not necessarily a sure thing. Do you have any concerns along those lines?
It's very hard to know. It's almost a theorem of sorts that it's very hard to predict where future prices are going to go relative to where they are right now, and it's a challenge in any asset market, and housing would be an example of that. I'm heartened by the increase we've seen. I don't expect that same rate of increase we saw over the past year to continue into 2013. At the same time, my outlook for housing prices is such that I don't expect a reversal of the kind you're describing. I think there are sufficiently strong forces to keep a rate of improvement. But I don't think it will be as strong as what we saw in 2012, which was surprising. If you'd asked me at the beginning of 2012, I was certainly surprised by the rate of increase that we ended up having in 2012.
But why would it be actually smaller?
You know, I think if you think about the challenge, prices are determined by the mix of demand and supply. Actually forecasting exactly where those are going to be over the course of a given year is very challenging. I think that the forces of demand were surprisingly strong relative to the forces of supply in 2012. I do not expect that to continue again into 2013.
Was 2012 perhaps like kind of a snapback in demand that is not?
I think people always are trying to see these kinds of patterns in the data. I think it's very hard to see that. Very hard to see that.
Your views on what's underpinning changes in the labour market have obviously evolved perhaps significantly over the past year, or at least publicly. How has that evolution continued? I mean, how have you refined that thinking?
You know, a lot of that evolution is tied to, there's two sources of information that's tied to. One is what's going on in terms of research, both within the Federal Reserve System and in academia, about the sources of high unemployment. You know, I keep seeing the same message coming out of that. So there's been no real reason to refine my thinking along, as you put it, along those lines. You know, the other major piece of information is what's happening with inflation, and underlying that, what's happening with wages. What you're worried about as a monetary policymaker is that the rate of inflation could end up being higher than is consistent with a given level of unemployment, could be higher than what has historically been true. That we're right now at 7% unemployment, that if we had structural damage to the unemployment in the labor market, then employers would not find the people who are not employed to be putting much downward pressure on wages. They would be viewing actually a much more limited pool of workers as being putting downward pressure on wages. And so you should see higher inflation than target at that point. We're not seeing that. I mean, you saw the inflation number that I pointed to. It's actually running closer to 1 than to 2. So I haven't seen, those are the kinds of things I keep looking at. I keep looking at the research on the micro level that's being done within the system and in the academia. You know, it's harder for the public to get a vision into that, but you know, if you read the speech that and the paper that was given by Professor Lazier at Jackson Hole, that's a very informative summary of that kind of work. And then as a monetary policymaker, what you keep watching is the inflation outlook to see if are there wage and inflation pressures developing at higher rates of unemployment than you might otherwise think. And I don't see that at this time. You know, but I'll emphasize on both levels, I remain open to the course of evidence. So it's not a kind of once and for all change. It's more you're continuing to evolve your thinking and your about policy based on the flow of data and information you have available.
Yeah, may I ask one more? Since you're not changing the numbers that you're seeing aren't changing, but you are feeling a little more upbeat. With the average on payrolls getting up close to 200 now over the last five months, I believe the word substantially that's in the statement, is that getting close to what you would consider substantially, or do you need to see numbers above 200 for several months in a row, 300?
You know, I really think of this, Jeff, as really a group decision. We have to get together and think about it as a group. And for me to be offering my own individual view on that, I just don't see it as particularly helpful. It's really going to be a collective decision. Statement has to come behind it and formulate a collective decision of what that means. And you know, I'm very interested in trying to build into the ultimate document, you know, a very reasonable description of a collective view of what substantial improvement means, as we were able to do in December with the Fed funds rate. Obviously, I have I have, as I've just talked at some length, I would like to lower that threshold even further, but I'm very pleased with the collective dynamic that brought us together to offer that degree of specificity to the American people. That's a real positive, and we should be able to do the same thing on asset purchases.
So just to follow up, so your concern and the uncertainty around that is dampening the effect of the policies?
Absolutely.
Please.
Question about the sort of the regional economy. It seems like the 9th district is doing like very well compared to much of the rest of the country. And I wonder if you see, so I do stories about that, how well everything's going, and I always get phone calls, people say, well, the jobs that are available are crappy. And I wonder if you see any evidence that there's sort of a change in the quality of the labor market in this part of the country specifically.
Well, I don't think I would say it's in this part of the country specifically. You know, these are concerns you'll hear raised around the country as a whole, that even the employment growth we've seen has not been in the kind of quality of jobs that people would like to see. You know, and I think this is a concern. I don't see it as a concern that's readily addressed using monetary policy, but I do see it as a concern. You know, I am struck in the 9th district between, on the one hand, I think things are going well relative to the rest of the country. They're going well. You're not great compared to historically, but well relative to historical norms. So, you know, unemployment rate in the 9th district is below 5.5%. It historically is lower than that, but not much. So we've made a tremendous amount of progress. But my conversations don't always, I would say, with households and businesses, don't always, their outlook does not always seem to be lining up with that kind of positive information, which is, I think, similar to what you're saying. And, you know, if I had a great answer for that question of why that is, I just don't. I mean, and I think that it's something for us to keep apprised of. I think that even as one of the lessons I'm drawing from it is just for the U.S. economy, that even as we continue to improve, I think we might still see some of the scarring, the lack of confidence, the concerns about jobs as really being something that we have to deal with on an ongoing basis in the U.S. as well. Because we're much closer to normalization in the 9th district than the U.S. economy is.
Right, and just as an observer and an economist, what do you attribute that to?
Yeah, there's lots of stories that are out there about that. I mean, I think that yeah, as a former educator, I come back to the value of education. I think we've not done as good a job in the country as a whole in terms of, if you look at the rate of growth of educational attainment in the U.S. over the last 20 years, it's not kept up with the rest of the world. So that's not a positive for us in terms of the kinds of jobs that are going to be available for the U.S. relative to the rest of the world. I think in the 9th district, we tend to be a little self-congratulatory about education because we compare ourselves to other parts of the nation, and I think we are doing better in other parts of the nation. It's not really the right comparison. Right comparison is with the rest of the world on that. And I think, you know, again, the rate of growth of educational attainment is dragging here relative to what you'd see in other countries, even our neighbor to the north. So.
Can you offer a bit of color on the long-term economic impact of either a speedier or a slower employment rate improvement?
Well, you know, I'm optimistic that we haven't seen much scarring effects on the labor market from the past 5 years. And you know, if we had faster labor, that would take more of that risk off the table. I think the concern is, that we saw develop in Europe in the 80s, is if you have high rates of unemployment for too long a period of time, that they tend to get, economists use this term hysteresis, they tend to get baked into the labor market picture more than you'd like them to. And so that's a risk we run. You'll hear that from if you go back to the chairman's Jackson Hole speech, you'll see that talked about in his remarks as well, that one of the risks about leaving the unemployment rate high for too long is it can become feed on itself and just become a persistent part of the background. And I decided my benchmark forecast by any means, but if things were to go more slowly than my benchmark outlook, noticeably so, then I think it's more of a risk that we have to worry about.